Hello, this is Jeremy North with your educational and economic update for July of 2022. In this month's video, I'll discuss major headlines that influenced markets in June, along with economic and market updates that we're looking at to influence August returns. Please stay tuned at the end of the video for the always exciting required disclosure statement. Inflation continued its upward trek as it rose from 8.3% in May to 8.6% in June. That was an unexpected jump that jarred the market, especially given that inflation had trickled down from 8.5% in April, leading investors to believe that we had seen the worst of inflation. The new reading at 8.6% helped prompt the Fed to take a more aggressive approach at hiking the Fed funds rate by 0.75% in June. That increase was the largest since 1994. The rate has now gone from nearly 0% 6 months ago to almost over 2% today. The fear is that this aggressive stance by the Fed will increase the risk of recession for our economy. Some analysts believe we are already in a mini recession as inflation's price increases have hit almost every aspect of our economy, putting a damper on consumer sentiment and spending, especially on those big ticket items. The red-hot housing market has cooled by all appearances. Mortgage brokers across the country are mourning the sudden reversal of fortune as mortgage lending has virtually dried up. The S&P was down 8.39% in June to bring its loss for the first 6 months to bear market territory at negative 20.79%. Safe havens such as gold and bonds did not help. Gold was down 2% and bonds were down as well, with the Ag Bond Index dropping 1.7% in June to bring its loss for the year down to negative 10.9%. These drops created the worst first 6 months in market history since the 1970s. With inflation, interest rates, and a new COVID variant just announced, the outlook for the second half of the year is becoming more and more uncertain. As real money columnist James DePore wrote, the most important thing to keep in mind is that the market does not have the support of the Feds right now. The best advice for the past decade has been, don't fight the Fed. And that is still the best advice. By this, he means for the past 12 to 14 years, the Fed has lowered rates to help keep the economy and, in turn, the markets keep chugging along. Now, with the Fed raising rates to fight inflation, it will no longer be able to help keep the markets propped up. With the negative momentum in both the stock and bond markets and investors pessimistic on the economy, some analysts are calling for caution. There is some hope that mortgage interest rates have stabilized, actually dropping 0.7% over the past couple weeks, actually driving home sales listing numbers the highest since 2008. In any case, we are prepared to help. As I mentioned last month, our general overall retirement investment strategy has been to keep a portion of our clients' portfolios protected from the market. We do this because we understand how volatile the markets can be, and having a sizable portion in protected accounts benefits your overall portfolio volatility, stabilizes your retirement income, and can put some certainty in this very uncertain environment. As always, we are continuing to diligently assess the economic and political implications for your investment portfolio. Should you have any concerns or questions, or just would like to discuss your personal situation, please give us a call or send me an email to jnorth@360ira.com. With all that being said, here's the disclosure I'm required to read. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results. Thanks again, Jeremy North, signing out for the month of July. I hope your summer is going well. I hope you're getting some great trips in, and I look forward to talking to you guys next month in August or sometime before then. Take care. Bye.